Hello, this nugget is part 1 of the Introduction to Shipping Finance. It looks at the key issues which make shipping finance different from other forms of finance. We'll start with ship ownership structures. Commonly, ships are owned by special purpose companies, often incorporated in tax-free jurisdictions and in countries such as Liberia, which have very limited company disclosure requirements. So there's no public record as the ultimate ownership of the ship. There are two principal reasons for this. Firstly, historically, shipping has been a family-run business to a large extent. Many of the largest ship owners have been Greek and Norwegian ship-owning families. As such, these families have sought privacy in relation to what they regard as their private financial affairs. Secondly, many countries have a concept of sister ship arrest, which allows one ship to be detained or arrested as security for payment of certain debts incurred in respect of any other ship owned by the same company. So, to minimize the risk of any ship being arrested, it's common for a ship to be owned by a company which owns only that ship, so that there are no sister ships. This single ship owning structure is the traditional form of ownership, but is not universal. Many corporate ship owners will not use a separate ship owning vehicle for each ship. If the SPC route is used, it has a significant impact on the financing. In particular, it means that unpaid creditors are more likely to take action against the ship rather than the company, so that insolvency risks are of less concern than in the corporate style of ownership. The next point to notice is that ships are traditionally priced in US dollars in the second-hand market. The price for a new building is often not denominated in dollars, and the income may not be in dollars, so there's a currency risk for the ship owner. The financing is usually arranged in dollars. Lenders seek to ensure that it's the ship owner who takes the currency risk during construction by limiting the final loan amount to a specified percentage of the dollar market value of the ship on delivery. This is also intended to protect the lender against any change in value as between the date on which the ship is ordered and the date on which she is delivered. Of course, this isn't foolproof, as we'll discuss in the nugget on new building finance. Commonly, if the income is not in dollars, lenders will require the borrower to hedge their interest rate exposure by entering into a swap, and then the security will be given as security for the loan and also for the potential liability of the ship owner under the swap. Shipping finance is a very specialized area, participation in which requires a high degree of specialized knowledge. Almost every aspect of ship finance is different from other forms of finance, as this nugget discusses. In addition, ships come in many different types, each of which will be affected by different issues. For example, the economics of a cruise liner are quite different from the economics for a general-purpose cargo ship, which are quite different from a reefer, a refrigerated vessel, and so on. This variety of ships and the variety of manufacturers also means that the residual value of a ship will be less predictable than, say, an aircraft. And even if a ship is properly maintained, it may still lose money if it needs to be repaired. As this nugget demonstrates, shipping finance is a high-risk business. Understanding the commercial market and the legal structures and risks is very important. The next crucial factor to consider is, of course, the fact that ships move. This brings with it a host of consequences in terms of physical and legal risks. The physical risks include, for example, risks of hijack, sinking, or entering a war zone. The legal risks include the fact that different laws will apply to the ship in the different places where she goes. One of the most important examples is port state control, which we discussed separately, but in essence, any port which the ship visits has the ability to detain her if she is not up to the required standards of safety. Another important example is liens. Different countries recognize different liens, so that claims which do not give rise to a right to arrest in one country do give rise to such a right in others. Another key example is procedures and priorities for enforcement of security. There is a vast difference in the time and expense required for enforcement in different countries, so that a procedure which could take a few months and result in a reasonable recovery for lenders in one country can take years and be practically pointless in others. When financial difficulties arise, the ship may be a long way from anywhere which would be a favourable jurisdiction for enforcement. The mobility of a ship has an upside, which is that ship ownership is a truly international business. The ship owner has a great deal of freedom when it comes to deciding where to locate the business. They can structure their affairs in whatever locations as will prove most efficient for operational and tax purposes. This is not just a case of having the ownership of the ship in a country which has a low or no corporation tax rate. There are many tax issues to consider, such as withholding tax on interest paid on any financing loan, withholding tax on dividends paid by companies involved in the ownership, operation and management of the ship, the availability of tonnage tax, which is a fixed tax based on the number and size of ships being operated by the relevant company, as opposed to a tax calculated on the basis of actual profits, where to employ the crew, for example, will there be an obligation to withhold local income tax on crew payments? If the companies involved pay corporation tax, at what rate and what deductions are available in computing the company's taxable profits? And whether any relevant countries will consolidate different companies for tax purposes and tax them all on their worldwide income.